Well, we are sitting at a grim milestone today, y'all. Interest rates are sitting at 22-year highs. How high have they gone? Well, let's talk about it. Today is August the 17th, Thursday. I hope you're doing well. We are seeing Mortgage News Daily. We'll just dive right into where the daily averages are. Mortgage News Daily has us at 7.37% nationally on a 30-year fixed rate conventional loan. Last week, Mortgage News Daily had us at 7.14, so we're up a quarter of a point this week. You go back 30 days, we were at 6.90 in that same national survey. So we've moved half a point in the last 30 days, just under. Freddie Mac also has us over 7. They're at 7.09 today. Mortgage Bankers Association has the national average at 7.16. I believe this is the first time that all of these national surveys have had interest rates on a 30-year fixed over 7%. So here's what's moving the markets, y'all. And it is an interesting bit of cart before the horse trading. And here's what I mean by that. The folks that buy fixed income securities are waiting for the Fed to moderate. They are waiting for the Fed to post a direction of the future of interest rates. And the Fed has made it clear that that is data driven. So they are waiting for every bit of news that comes out regarding inflation, of course, regarding employment, and regarding the strength of the economy. And all the recent data has shown that the economy, specifically jobs, have been remarkably resilient, and that interest rates and that inflation has been moderating at a pretty aggressive pace. So the Fed is waiting to see if that trend holds, and if so, what do? Well, when the Fed moves, when they affect the overnight discount rate or the borrowing rate between banks, it has a direct impact on the prices for short-term securities, namely 2-year securities. The bond traders that are out there, even though those don't directly tie to a 30-year fixed-rate mortgage, bond investors watch that 2-year note to see when those prices bottom out. They just haven't seen it bottom yet. We have talked a lot about the fact that the federal government is having to flood the market with supply of fixed income securities to cover debt that is at record levels. This last bond auction, or the amount of debt that has to be issued this quarter, $300 billion more than this same time last year for Q3 of last year. So we are seeing the federal government having to issue a lot more debt. How much further will that drive fixed income prices down? You know, fixed income buyers are the same as folks that buy in the stock market. They want to buy low and sell high. They want to try and call the bottom, and they just don't see a bottom yet, and they're sitting on the sidelines. So another way to say it is they know interest rates are headed lower, and that's pushing rates higher because as investors, they're just not wading into the pool to buy at the current levels because they don't think we've seen a bottom yet in prices. That also, of course, means we haven't seen a high yet in interest rates, y'all. So we may be headed higher still. Let's put this into perspective. From a buying power standpoint, here's what this grim milestone presents to us, y'all. And then we'll talk a little bit about how to sell around, how to go on with our jobs in moving real estate in these trying times. A $400,000 mortgage at 7.37, which is the national average today, gives you a payment of $2,761, a little bit under $2,800. That same payment at 2.65, which was the all-time low. Y'all, I went back through the Freddie Mac survey. You go back to January 7th of 2021, so just 2.5 years ago, the national average was 2.65, according to Freddie Mac. That is the all-time low that I could find. So I believe that January 7, 21, all-time lowest interest rates that you could have had on a national average. That same 2.65 on that same payment rather of $2,761 at 2.65, the all-time low, would have had you borrowing $685,257. In other words, in 2.5 years, we've lost $285,000 in purchasing power. That is the hill that we have to climb. That defines, by the way, the golden handcuffs that our sellers have tied themselves to. We have millions of mortgages out there at these extremely low rates. And those sellers are well aware when they do a little bit of the math, and there's so many tools online, I have them on my website as well, where folks can go in and do these payment comparisons, and they know full well that if they were to borrow at a payment similar to what they have now, they're not buying anywhere near the same amount of house that they currently occupy. So they're effectively stuck in it. They're stuck at these low rates. It's wonderful that they have it, but if they want to move, they're being shocked by the amount that they can buy given the same payment going forward. That's what we have to work around, folks. And there are a number of ways to do that. First and foremost, y'all, incomes are up significantly in that same 2.5-year period. Affordability is up significantly in that same 2.5-year period. So there's a number of things that we can look at. The equity that they have in their current house is up significantly from where it was 2.5 years ago. That's what I mean by affordability for the house to buy. They're going to cash out of that home in a way that is very significantly higher than what they paid for it when they bought it, and they can put that into the new house. Or they can use some of it to buy discount to buy their rate down on that new house. And since the whole world is expecting interest rates to be significantly lower a year from now, folks, that gives them the opportunity to buy at what may turn into somewhat depressed levels because of the price degradation we're going to see at these higher interest rates. It is going to hurt the market in the short term. But if rates do come down significantly a year from now, we're going to be back into an appreciation cycle. We're going to be back into extreme inventory issues that are even worse than today's standards. And we're going to see that rapid appreciation returning at that point. So buying now makes some sense, and then refinancing down the road. And by the way, we have a program that allows for that. We cover the closing cost on the loan if they see a significant savings 6 months down the road even. We'll be happy to take a look at doing a refinance and eating those closing costs on their behalf. So in any event, there are a number of tools that I like to discuss with buyers that are frankly scared by these high interest rates today. But where interest rates are today is not where they're going to be a year from now or 2 years from now. And refinancing is a thing, y'all. Like we always say, marry the house, but date the mortgage. You can divorce that mortgage as soon as interest rates improve to the point where it makes it worth your while. I'm always happy to run those numbers, folks. So in any event, hope some of this information is helpful for you and for your clients. As always, I'm free to visit, and I'm always honored to have your referrals. All my contact information is on the screen. Stay blessed, stay safe. We will talk to you next week.